So again, the link is at the top of the room. Matter of fact, let me just put it in the chat real quick. Okay. Give everybody a chance to get over here, and then we will get it to rolling. All right. So of course, as y'all know, I will be talking over on Twitch. My mic is going to be muted on Clubhouse. All right, let's do this. All right. So today, the goal is to help everybody understand the goal is to help everybody understand the co-pivot indicator a lot better. All right. So this way you can, you know, this way you can use it more efficiently and more confidently. All right. This is for those that are new to using a pivot indicator, or those that are, that are thinking about grabbing them one, or even those that have been using it for a while, because you guys know we make changes here and there to to just kind of adjust the strategies. Okay, so here we go. Let's talk about it. Let me go ahead and pull up the. All right. And not sure if there is anyone here that doesn't have it yet. GA. A lot of these guys have had it for a while. What's up, Genia? Actually, GA, you want to hear a fun fact? Fun fact. My all right, I got you, GA. Much appreciated. Fun fact, right? GA, check this out. I can't remember what year it was, but I started a group, uh, a few years back, and the intent of this group was to take on some students who actually had the luxury of learning how to like how to do all the things that I was doing, but also testing out all of this stuff firsthand. So they were like able to, before this was even called the Pro Pivot Indicator, it was called the Trader's Cheat Sheet, like the one on like the one on like the one on bar chart, right? So they've been using it since then. This was like years ago, right? Years ago. Shout out for the follow. Orange Jeans 888. Shout out for the follow. Much appreciated. Much appreciated. So yeah, man. So they got to test all this stuff out ahead of time, and they really helped me out with building. They really helped me out with building this stuff out. Because if it wasn't for them, I might not have the same direction. You know, like they may not have the same direction, like with these tools because I was able to bounce ideas off of them while they were learning, right? So that's a unique experience, not just for a student, but also for teachers, right? So, all right, let's get into it. All right, let's get into it now. So as far as the pro pivot indicator is concerned, okay, I think the first thing that anybody should know about the pro pivot indicator, right, before they the first thing that anybody should know about the pro pivot indicator um before they really dive deep into just staring at levels and so on and so forth, right? Um Now you want to what you want to do is you want to just kind of understand what it's all about. So we have multiple strategies built into this. We have multiple strategies built into the spreadsheet, right? And then the spreadsheet itself works around different strategies. Right? It works around different strategies. So, for example, if I was a trend following trader, right? If I was a trend following trader, then I have my monthly high and lows, right? My 20-day range. I have my 8-day SMA. I have my 8-day trend, which is not the same thing, right? I have my 8-day trend, I have my monthly trend. I have uh, right here my bullish and bearish key levels. As I trade above these, it helps me to stay with the trend. Also at the same time, um, you know, also at the same time, you have where I can tell when the trend is getting hot, right? I can tell when the trend's getting hot because I have my standard deviations, right? And I have my monthly, like extreme levels, right? These are my monthly extremes. So if I'm a trend follower, I can tell where trends are just beginning, right? I can tell where they're just beginning. I can tell where trends are breaking structure, and I can tell where they're getting overheated. If I'm a mean reversion trader, where I like to trade those points where the market just kind of hits an extreme and kind of folds over from there and starts to revert back towards the average. If I'm that type of a trader, well, the sheet is built perfectly for that as well, right? This particular indicator gives you all of your extreme levels, right? I have my weekly extreme levels here, third resistance, third support. I have my monthly extreme levels, third support, third resistance. I have my standard deviations, right? Fourth, and second standard deviations on both sides, right? On both sides. So I know when we're overheating to the downside, I know when we're overheating to the upside, right? Also, because I have my 8-day trend, my signals here, I have my 8-day SMAs, my uptick, my pulse. These will let me know when the trend starts to either strengthen after hitting extreme levels to the downside, or when it's starting to weaken after hitting extreme levels to the upside. Right? These are all things I get to know also my stop losses, themselves are great indications of reversals, right? Even the stop losses themselves, I repeat, are great indications of reversals. So we have ourselves set up perfectly to benefit in that particular way. All right. Now, let's start diving into the different concepts. Start diving into the different concepts, right? The first concept I believe is important to understand on the pro pivot indicator is the concept of consolidation, right? The concept of consolidation. Um, Follow Astacio. What's going on, man? Much appreciated for the follow. I believe that's Anthony, right? What's going on, Anthony? Shay, I see you. I see you. What's going on? Bloom, what's going on? I see you. All right. Hope everybody's doing well today. Hope everybody's doing well today. I see we starting to get a packed house. I'm happy to see you here. Now, as I was saying, the first concept that you should grasp, right, is the concept of consolidation when it comes down to the pro pivot indicator. All right. Now, as I did earlier, let's go over to. I'm going to go over to. So I want you to focus on these right here, right? Low range, high range. This is the first thing you want to set your eyes on when you come to the pro pivot indicator. Low range and high range. That's the first thing you want to look at. Let me show you what I'm talking about. Watch this. Right. Let's go to SMH. Okay. This is the semiconductor ETF, and what you'll notice is all of a sudden my high range is lit green. If I was on the low range and below the low range, it would be lit red. Okay. Now notice, now that I'm lit green, I have a lot more green going on this side as well, right? So it actually gives you these are actual signals, guys, right? It's not just a spreadsheet that just plug this in and gives me throw some numbers at me. No, like it gives you real life signals. This is important. Okay. So when it's lit green, what that means is we are outside of the consolidation range. Let me take you over here to TradingView really quickly. Okay, let's go over to TradingView really quickly. Let's do this here, right? I'm gonna add the 20-day moving average. All right, let's go with the simple moving average here. Boom. Okay. Let's change that to 20 days. I'm not gonna bother worrying about the color. Okay. 20 days. Boom. Now, what it's telling us here, right? So this is one close and two close within this range here. All right. If I was to let me just move some of this stuff out of the way here, right? We don't need this, we don't need these right now. So we're gonna move this out of the way. Let's get this out of here. Okay. So I'm gonna put the range for IWM on my chart. Okay. So we have 245.41 on the high end. All right, 245.41 on the high end, right? Right there. We have 242.40 on the low end. Let me just show you guys what this is all about. 242.40 on the low end. Okay. So this range right here around, and I want you to notice how flat that 20 MA is right now. You see how flat that 20 MA is? Look at it. It's a straight line flat work, right? So outside of that, it's where you close at. So you can see we closed within this range 2 days in a row. Now, again, like I said, this is the first thing you want to understand. If I am outside of this range to the upside, right, that's a greater indication that I'm bullish. From outside of this range to the downside is a greater indication that I am bearish. Being within this range is trendless, and that's why your 20 MA is so flat right now. But there's more. Let's talk about it. Let's talk about it. Okay? The longer I spend, right? The longer I spend in this range, right? The more time I spend in this range, it's going to be a beautiful thing. Okay? Here's why it's going to be beautiful, because when I finally break out of this range, that's a stronger signal. That's a stronger signal, guys. When I finally break out of this range, that is a stronger signal. So if I can spend 1, 2, 3, 4, maybe even 5 days inside this range right here, right? You see this? Gotcha. We're going to come around to that one. We'll come back around to that question. Okay. So I'm going to be breaking down each particular portion that's important for today. I'm going to break down 3 to 5 concepts today. I'm going to break down 3 to 5 concepts today that you can focus on with the indicator, and then we're going to talk risk management, and then we're going to talk risk management. All right, and the built-in risk management. All right, and we're going to talk confirmations a little bit. Okay. So now here's the deal. Follow Estacio, you just caught yourself a sub, so you don't have to deal with ads. Much appreciated, GA. Anthony there is one of our, longest term members. So, definitely I'm happy to see him, popping in. He's back with the fam, man. Back with the fam. Much appreciated, GA. Much appreciated. So, as I was saying here, right? Oh, by the way, those who have subscriptions also have access to on demand, meaning you can come back later and rewatch this stream. So that's the other beautiful thing about having a sub. Okay. Now, as I was saying here, right? So the more time you spend in this range, right? The more time you spend in this range, the greater the significance of the breakout once you finally close outside of that range, right? We talked a close outside of that range. And very similar. Good afternoon, Cecily. I see you made it. Very, very similar to when you break outside of the 1 standard deviation range, right? You have greater confirmation closing outside of the 1 standard deviation, right? That's your first range that you want to be looking at. So the minute I open up my pull pivot indicator, right? The minute I open it up, this is the first concept I want to focus on. Are we inside the high and low range, or are we outside the high and low range? And what direction are we going at there? Right? That's the first thing I want to look at. Now, when it comes down to the concept of being outside of this range, watch this. I'm gonna show you guys a little trick here. Right? So let's say I'm outside of this range to the downside. If you notice, I'm also below my 8-day SMA. I'm also below my 8-day SMA. So that tells me that I have what's known as a short order. Okay, I repeat, that's known as a short order. Let me show you what that looks like. Okay, let me show you what that looks like. So a short order means that let's imagine this trend line I'm about to put here as my 8-day average, right? And it's here, right? So my 20-day average is here, my 8-day average was here, let's just say. If I'm also trading below this 8-day average, then, right, so price being down here means I have a short order. Okay? Now, imagine if I'm trading below the low end of this range, but I'm above the 8-day SMA, right? That means I'm here. I'm in this point right here, which means that I'm either heading back higher towards the 20 MA, right? Or I could be in a range, as it was stating. You see how that works? Think about that. Now, so check this out. So now I want you to imagine you were further down this line here also. So I'm below the low range, and I'm at the 4 standard deviation. Then I start to bounce, and I bounce above, right? My 8-day turns green. That's a signal. That's a concept. That's why this low range is so important. Because now I know I may be getting confirmation that I'm heading back upward towards my 20-period moving average. Okay? So here's how this usually looks, right? So if I'm trading really far below my low range, right? It usually looks like this. So pretty much price, let's move this over here. So pretty much my price is all the way down here. Let's get rid of this real quick, and let's zoom out a little bit. Okay. So it means my 20 MA is all the way up here, right? And the price of my stock is usually, all the way down here. Okay. So I just want you to imagine, right? Let's imagine that, I actually start to pick up now. Right? And now I'm back above my 8-period moving average. So that means I'm heading back towards my 20-period moving average. Okay. So once I get back above that 8 MA, so again, but here's the deal. The idea here, right, is that the idea here is just from opening up my pull pivot indicator, I can already see that without even looking at the chart. Right? So if I'm below the low range but above the 8, right, then all I need to do is, when I look at the chart, am I bouncing or not? Am I headed back to the upside or not? Right? Or am I bouncing off of the 20 MA and, right, boom. Now, but if I'm on the low end of my range and I'm above the 8, then I know I'm coming off of a low. I can tell I'm coming off of a low. So this becomes really important there, for those medium term swing trades, right? Now again, we're still focusing on ranges. Okay. So again, when you get far above the range or far below the range, chances are you're heading back towards the range, and that's where this 8-day SMA can really help you without really having to just stare at charts all day. Right? Now, here's the other idea here. The other idea is the weekly range here. So if I'm above my weekly pivot, but I've not broken above my weekly resistance here, right? Or my weekly support, broken below that, right? My first level of support, then this is a range as well that you want to focus on. Okay. So a lot of strategies, a lot of concepts involve closing above the first resistance first, and then targeting your second and third resistance, because we're talking about the weekly chart. So I'll repeat, a lot of concepts involve closing above that first point of resistance, right? Or below that first point of support first. Now that can be confirmation. So for example, let's say my 8-day trend started to light up, right? Like it's lit up red right now. First things first, as you can see, this is green right now. This means I'm above my weekly pivot. Okay. What I want to be is red below my weekly pivot if I have an 8-day trend that's in red. And what would be helpful is if I was to close, boom, below that first support. Now, pay attention to this, right? That also means I would have already been below, right, the bearish key level here. So that means I have settled something settled in, right? Something settled in here, and that can be a great opportunity to take a trade. So again, we're just talking ranges, right? So I want to be outside of these ranges. I want to be outside of these ranges when I'm going for a trend following trade. If I'm looking to trade the ups and downs of being within that range, well, no problem, right? If we rally up, right? If we rally up and we hit the top end, if we rally up and we hit the top end of this range and start to fall from here, right? It's a nice short-term swing from 245 to 242. It's a nice short-term swing. It ain't, it's not the best. It's just a day trade, right? I'm just day trading. Boom, 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 boom. So I'll probably go to the 15-minute chart, right? And would you look at that? Right? See that? That's 15-minute chart. Boom. You found resistance right here. Where did you go? Right to the low end of the range. You found support around that area. Where are you headed? You're headed back towards the top end of the range. Okay. So for those day traders out there, right? Whenever you get in this range, it's important that you can just look at these ranges and see if if you have something here that you can trade. If it stays in this range, then you're good. But if it closes outside of this range, right, you want to focus on the longer term trend here. You can see again as you're finding some support here at the low end of the range, you're starting to push higher, right? Let's go back to the daily. Let's focusing on the daily for right now. All right, now the 8-day trend and the monthly trend, these also have ranges around them, right? Now, just like the 20-day average, right? This high range and low range here. So this high range and low range is around your 20-day average, as we talked about. These are ranges around your highs and lows. These are ranges around your highs and lows. So this first trigger here lets you know that you're within a half a standard deviation. You're within a half standard deviation of your you're within a half standard deviation of your 8-day high or your 8-day low. And what it's going to do is if this remains red, but it never turns bold, right? The letters will turn the letters will turn bold. So if this remains red, but it never turns bold, then in that particular case, you'll know that you're still just kind of ranging around the high. You haven't broken out yet, right? That can be known as a flag, right? That can be known as a flag. So let's say you were breaking down, boom, right? The market dropped, but you stayed within a half a standard deviation of that low. You might be flagging at the moment and preparing for a breakout, right? A continuation. Okay. So this would be great for understanding this range would be great for understanding potential continuation patterns on the way. Okay. Now also, if you get a bold signal out of this, but you immediately reject that back to the downside, that's known as a pivot point rejection. Right? So this signal makes sure that you get at least a half a standard deviation or half of the average true range outside of that high. Right? I repeat, this signal makes sure that you get at least a 0.5 standard deviation outside of that high. And so it doesn't, force you to have to go on your chart and mark all that stuff up, right? It'll automatically do it for you. All right. Now, here you have your monthly trend. So this is your 20-day high and low, and we're going to talk about this more in depth, as I said, Anthony, in a few moments. But for now, we're talking about the range around these highs and lows. That's what we're talking about for now, right? So essentially, the range around these highs and lows, when it's all said and done, from a monthly perspective, lets you know whether you're either flagging or you're breaking out from a monthly perspective, or are you getting a pivot point rejection, right? Or are you getting a pivot point rejection, in which case, right, is a reversal signal. What's going to be important is to notice, where are you on the RSI when you approach these levels? So for example, right, I'm getting within a 0.5 standard deviation of the 8-day low. I also want to point out I'm within a 0.5 standard deviation of the 20-day moving average. So ranging, right? But where am I on the RSI? I'm still above 50 on the RSI. Right? I'm still above 50 on the RSI. So there's still some strength in this upward trend that we've been experiencing. Right? So what would be great is if I would close below this point while I approach these 8-day lows, while I approach these monthly lows. That would be great. Okay. Now, the question was asked earlier, right? What is the significance of the monthly high and low and trend following? Right? Let's talk about that. So the significance, and see, now this is going to be the difference between that whole turtle trading thing that we watched the other day, and how we look at it from our perspective, right? Because we don't have these here because of the turtle traders. We have these here because it's something that we look at ourselves, right? We like to look at 20-day monthly moves and stuff like that. Now, here's how you really look at it, right? From a monthly perspective, let's go to the monthly chart here. Give me a second here. Let me just get this out of the way here. All right, and I'm going to keep this off of the chart. We still don't need to look at this for right now. We'll talk about that another day. One second. Okay. There we go. Let's go to the monthly chart here, right? So here's the deal, right? So that way we can really highlight this. So I want you to imagine anybody that bought at this point right here, right? Anybody that bought in this month right here, right? I want you to imagine that. When we break above the high of that month, that actually now means that everybody that purchased in that month is now profitable, right? And let me ask y'all a question, man. How do you think people feel in markets when they see other people making money? Right? What are your thoughts on that? When they start seeing other people making money, they start to think, well, there's some money to be made for them. They start to think that there's some money to be made for them. So the significance of these monthly highs and lows is that when you break these highs, right, people start to think, oh, money's being made. I want to make some money too. And they start to follow the trend, right? Now, when you start to see people getting trapped and losing money, right, when that starts to happen, the market starts to break down, well, people start to think, well, maybe the money making is over, right? And you get a lot of this sometimes. Okay, so that's the significance of those highs and lows. So you get to really tell whether or not people you get to tell whether or not people you know are truly optimistic about the market or not. Okay, you get to tell whether or not people are truly optimistic about the market. All right, now that's the significance there. And you also do have, like I said, trend following systems that are built on that. That once you break the 20-day high, they're in there, right? So that's known as the turtle trading system, right? So if somebody's here that does trade that, you always have your key levels here and here to really focus on, right? But what our system does is it gives you a realistic understanding of whether or not the market is truly breaking out or not. And what you're looking for are weekly closes above these trends. So all right. So that's all there is about the ranges, right? So again, when you're in this range, you're consolidating around the 20 MA, and that usually means you have a trendless market at the moment. The longer you stay in this range, the more like the better it's going to be when it breaks out, right? Um, when you're lit up here or here, red or green, that means you're consolidating around the high, or you're within the ranges of the high, right? You're within the range, and that's usually a half standard deviation on both sides. So it's a one standard deviation range around the high or the low. And that's important because it lets you know whether or not you're just kind of flagging at the high, consolidating at the high, and things of that nature. Consolidating at the high or the low with high relative volume is a sign of accumulation and distribution as well. We'll talk about those things more over time. All right. Now, let's get to the next portion here, and that's you know outside of those particular concepts, right? You also have concepts for breakouts. All right, so outside of understanding the ranges, you have concepts for breakouts as well. So the first concept for breakouts comes after you've had this right here, where you have no coloration, no colors on either side of the range. Once you finally break in either direction, so boom, right, it turns green. Right, let's say, right, that is actually a breakout. That's a breakout. Right. So now we're talking understanding breakouts. So first we talked about consolidation. Now let's talk about breakouts. Okay. So when this is again, when this is not lit up at all, that means you're in a consolidation range. Once it finally lights up, boom, especially if it's been in this range for a few days. So far we've got 2 days closing in this range. Once it breaks out of this range, right, in either direction, and you get this, so if it breaks out this way, this is going to turn green. This way, it's going to turn red. Then you know you have a better breakout signal, right? So that's signal number one I pay attention to if it's there for me. Okay. Now I'm gonna let y'all in on another little secret. This one is very important. See, it says deviation right here. This is the amount that that I usually deviate away from the 20-day average, right? See, it says deviation right here. You see this number is bold? See, this number is bold. Here's the secret. Whenever this number is bold, that means we are currently in a low volatility environment. And a big breakout is likely coming. I repeat, that means we're in a low volatility environment and a big breakout is likely coming. So you see how this has been like this, and then all of a sudden you get this big day, boom, big day back up, boom, boom, right? That's because this you got this going on. Look at this. Look at these little pebbles of moves. The market is just dying for some of this right here. The market's just dying for some of this action right here. And all it's waiting for is a catalyst. All it is waiting for is for something to happen that gives them the right to buy or sell in a big way. I repeat, whenever this number right here is bold, no, right? I'm talking specifically about this number, not all the other numbers. This number right here, this deviation, whenever this number is bold, that means the market is coiling, right? It's coiled tight and just waiting for something to happen so that it can explode to the upside or to the downside. Okay? So when it comes down to breakouts, when I do finally break out in either direction, okay, when that finally does happen, I break out upside or downside. When that finally happens, I'm talking about a big breakout, not no little breakout, big breakouts. When that finally happens, this right here says it's going to be big. It's going to be big. When this number finally is no longer bold, that means you got the breakout you were looking for. It's happening. So if you're trading something on a normal basis and this number is bold, trade it like you normally would, right? But understand that those moves can be short lived, and that's what we've been getting, right? Short lived move to the upside, short lived move to the downside, short lived move to the upside, short lived move to the downside. That's what we've been getting, right? But once this number finally releases, it's no longer bold, or your move is happening. Okay, it's a move. All right, so I want y'all to really pay attention to that. Know that, right? So when it comes down to breakouts, this is your sign that you're looking for a bigger breakout. Right? You might be getting a breakout right then and there, but if this number is still bold, it's not the breakout you're waiting for. So be quickly in and out, right? That's the times when I'm trading overnight. I'm trading for 24 hours, 72 hours. But I'm taking my money. I'm out of there. Okay? Also, when these numbers get bold, when these words get bold, right? When these words get bold, right? You're also waiting for a breakout. Okay? So you're also experiencing a breakout, I meant to say, right? So and you get a greater confirmation that breakout is happening when you actually close the day or the week with these being bold. Right? These being bold, right? So think bold, the being bold is for breakout. Think about it like that, right? The being bold is for breakout. All right, on these levels here. So when these numbers get bold, you're breaking out. Okay? And it's a more confirmed breakout because I have a 1 standard deviation range mapped out. So when this gets bold, it lets us know that we are beyond a half a standard deviation from the high over this period, right? The 8-day of the monthly, right? That was the reason we took the Cisco. Yes, that was the reason we took the Cisco. Now, I do have a slight difference here. We'll look at Cisco in a second. There is a slight difference with these signals, right? A slight difference with these signals from yesterday's, right? But the only difference is the deviation range. That's the only difference. Okay. Now, either way, you are looking at your bold letters as a breakout signal. Okay, these are breakout signals. So if this was bold and red, then that means we closed at an 8-day low. And it wouldn't have been a bad idea to take that short, especially if you especially if you close below 50 on the RSI, right? So you have to have your confirmations. We're going to talk about confirmations in in a second. We're going to talk about all the confirmations that you can use for your trades. Right now, we're talking breakout signals. Right now, we're talking breakout signals. Okay. Now, also, if you close the day above your first resistance or below your first support, these are also breakout signals. So if I'm already above my weekly pivot and then I close above my first resistance, that's also a breakout signal. And if it coincides with closing above the high range and a bullish 8-day trend, for example, right? I repeat, if it closes above the first resistance and it coincides with a breakout above the high range, right, and a bullish 8-day trend, then that can be an even stronger signal. And of course, if you close above the bullish key level, an even stronger signal exists. All right. Now, your other confirmation here is going to be your relative volume. Right? We have relative volume here. Now, when you're looking at indexes, your relative volume is at the top. But if I pull up a stock, let's point this out. Let's pull up Cisco since we were just talking about Cisco. All right. If I pull up a stock right here, my relative strength is down below. Right. So you're gonna be looking for especially when you're dealing with ETFs. I repeat, especially when you're dealing with ETFs, I would usually be looking for a higher volume than this. Right? I would usually be looking for a higher volume than this. So that's the one thing about Cisco that they didn't have on Friday was high volume. Right? But what they did have was a close above the first resistance, a close outside of the high range and out and above the first standard deviation. They have a long order, right? Closing above the 8-day SMA, closing above the 8-day trend, and closing above the 8-day signal, right? Bullish key level on the weekly chart. So now you guys are going to get this particular version of the spreadsheet when we close out the stream. Okay, this particular version of the spreadsheet is going to go out as soon as I close out the stream. This version is going out. Okay, but as you can see, so they had a lot of confirmation there. Also, let's go over here. Also for Cisco, right? They closed above 50 on the RSI. Okay, so there was some great confirmations there. But no, again, your relative strength is on the bottom here. You see, relative volume, I meant to say, is on the bottom here. And this is your RSI, by the way. But your relative volume is here on the, when you're looking at a stock, right? But when you're looking at an ETF, like IWM, your relative volume is at the top, right? And this is your volume itself. Okay? So let's just be clear about that. All right? Now, so those are your breakout signals there, and then you have your bullish key level for your daily breakouts. So this is for your daily breakouts, your bullish and bearish key level. So we do the opening range breakout. Opening range breakout. So what you can do, right, is after the first 15 minutes of the day, right, you take your bullish and your bearish key level. So 244.90, 241.75, right? 244.90. And I'm just going to use this one right here. I think it was 241.75, right? Yeah, so pretty much, right? When the day, after the first 15 minutes of the day, you take your bullish and bearish key level, right there, and you plot them on your chart with 2 trend lines. Boom. Okay. You can look for the next 15 minutes to close above or below one of these key levels, or you can look for the hourly or the 30-minute chart to close above or below these key levels. Okay. That's up to you. It depends on how you want to handle yourself as a trader. Are you looking for stronger, more confirmed breakouts, or how are you looking for that, right? Now, also, you can put your bullish and bearish key level after the first 15 minutes, but you can also do after the first 30 minutes or an hour. Right? So if you were looking for a longer term move, maybe a swing into the next day, then use the hourly chart, right? And put your bullish and bearish key level after the first hourly candle closes. Okay. And then if you close below that in the next hour, then you can trade that in, maybe throughout the rest of the day or the next day, right? Right here you have your daily bias. See right here you have your daily bias. So if I was trading the opening range breakout, then my daily bias is going to be important for me. Now, what I want to see is 2 consecutive candles that close above the daily bias, right? And that's going to, I typically use 15-minute candles, right? Closing above the daily bias, that gives me a bullish bias, or 2 consecutive candles that close below the daily bias, that gives me a bearish bias, okay? You also have right here your range, and we'll talk more about that in a second. But basically, this is your, like, how much of the average range have you already used up in the day? So this one here says 91.38%. All right. So if I was about to take a trade, I may not take it unless I get some very strong confirmations here, right? Like I want to see closing above the 8-day trend, the monthly trend, whatever, at the end of the day, and then I can take that trade. Otherwise, I'd probably just stay out of the way, right? I probably wouldn't touch it because most of the range is already gone. You want this number to be below 50%, so you know that you still have at least half the daily range to go. Okay, so let's recap a little bit here. All right, we talked about the ranges, right? Your low range and your high range signals whether or not you're consolidating from a monthly perspective around the 20-day moving average, right? Your first support and your first resistance lets you know whether or not you're consolidating from a weekly perspective, right? Pretty much a rangeless week without a breakout, okay? Your 8-day trend and your monthly trend have colors that show up that let you know whether or not you're approaching the 8-day high and low or the monthly high and low. And when they light up, it lets you know that you're within range. So until these letters here become bold, until these words become bold, you have not had a breakout yet. You're still in a range. All right. This could be flagging. It could be preparation for a bounce or a reversal. All right. Whatever the case may be, right? You're still in that range and you have not had a breakout yet. Right. So, these are your 4 ranges that you focus on. Okay. Then your breakouts come when you start to break outside of these ranges, right? When these become bold, right? Your 8-day trend and your monthly trend, when they become bold, you're breaking out, right? When your low range and your high range, right? Either turn red or green, you're breaking out. When you're above the first resistance or the second support, you're breaking out. Now, again, shout out to Aldrin for the gifted sub. Okay. I see you, Prince, catching the sub today. Shout out to Aldrin, much appreciated. So again, when you break out of this, you see these letters getting bold, these numbers getting bold, right? Now, then you have your opening range breakout. You have your opening range breakout. This strategy is right here for you to use. You don't have to even think about it now. You just literally just set yourself up, boom, and go. Okay. Now, those are all your breakout strategies that we just talked about. Okay. Now, let's talk about your false breakouts or your pivot point rejections. Okay. And we really look for that in certain key areas. Like, for example, your second resistance, your third resistance. If you hit these levels and reject these levels, right, that becomes a pivot point rejection that you can trade back to the downside, back towards the pivot, right? Same thing to the downside. I can trade back to the upside, back towards the pivot, right? These are known as pivot point rejections. Also here, with the second, third, and fourth standard deviation, right? The further I go in the deviations, the more likely it is I'm going to catch a reversal signal or a false breakout at some point. That's going to lead me back down towards the 20 MA. So the further down the third or fourth or second standard deviation I go, the further away from the 20 MA I actually am. And, you can always check out my guy, Oliver Velez, on YouTube, and he'll break all of this down for you. You can get away from this 20-period moving average. You can't stay away from it. So the further away from the 20-period moving average you go, the more likely it is you're going to get a false breakout at some point that's going to lead to a huge drop back to the 20-day moving average. Okay? So these are your false breaks there. Also, your 8-day trend, your monthly trend, right? If you have this 8-day trend here that then bounces backwards and starts to push back towards, right, these key levels here, then you're gonna, obviously you're getting a false breakout above the highs, right? Or a false test of the highs, right? Or failure swing. So this turns red and then all of a sudden goes back blank. Trade with the 20 MA. Yes, sir. Trade with it. Right? So that's why it's so important to watch this high. That's why I said this is the first thing you look at right here. So if I get back above this, I want to take long positions. Right? So I look for pullbacks and stuff like that to take long positions, right? Now, if I bounce and I hit this 8-day trend here and I start to bounce back and it goes blank again, right? That means I just had a false breakout or a failure swing, right? And if that continues to the upside, boom, 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 then I know that I can start to take the bullish stance. And like Anthony just said, especially if I'm on the high end of the range. If I'm getting an 8-day bearish trend and I'm on the high end of the range, right? I could be looking for a bounce from here back to the upside. Okay. So again, these are all reversal and reversion ideas. All reversal and reversion ideas. So the same thing here. If I'm too far away from the 20 MA, I'm all the way out here, and I hit the bullish trend on the 8-day, and then I push back and it goes blank. Right, this 8-day trend goes blank after hitting the fourth standard deviation. Right? That means I'm probably heading back towards the low end of that 8-day range, and I'm pulling back towards the 20 MA. I'm getting a reversion to the mean. So these are all ideas around reversions. Now, every Saturday I'm gonna work on helping you guys understand this more. Today I'm giving you the full plate. Right? I'm giving you the full plate today. But then next week, Saturday, we're going to focus on specific, right? We're going to focus on specific types of strategies. So one Saturday, we'll focus on breakout strategies. Another Saturday, we'll focus on reversion strategies, right? Another Saturday, we'll focus on ranging strategies and so on and so forth, right? Or understanding ranges. Okay. Also, we'll also talk about the Fibonacci's next week and the monthly R3S3. I don't want to do that today because that's we don't want to move our mind away from pivot points and standard deviations right now. Okay. Now, here's the deal. All right. Let's talk confirmations now. So when I get these signals, what confirmations am I looking for? All right. So whenever I'm looking at the range, let's say I'm looking at the range right here, right? The low range and high range. Okay. What I'm looking for here is as I break above the high range, right? As I break above the high range, right? I'm going to be looking for the market to be breaking above and closing above 50 on the RSI. Okay. Also, it would be great if we never broke below 40. That would be even better. Right? From breaking the low range to the downside, right? Then I would want to see the market breaking below and closing below 50 on the RSI. And it would be great if it never got above 60. Okay. Also, what would be great is if we're bouncing off of divergences, right? Let's say we had a divergence. Let's say we're going back above the high range, and we just had a bullish divergence. That would be great. Let's say we're going back below the low range, and we just had a bearish divergence on the RSI. That would be great. Divergence is also great for these pivot point rejections that I just talked about. So we hit the third standard deviation or third resistance, and in hitting the third resistance, we had a lower high on the RSI, for example, right? Stuff like that. Okay. Now the same thing goes up here. Imagine I'm hitting the 8-day trend to the downside, but I'm getting a bullish divergence at the same time. This is probably a false signal, right? I'm going to need to see a lower high. So I'm going to need to see the market bounce first and then come back to the downside. Then I'll take the trade. Okay, stuff like that is important, right? Now, other confirmations include weekly closes. This is also going to be important, right? So a weekly close would have been really great, right? Above the or below the monthly trend. That'd have been really great. That lets us know that the macro environment supported that close. Okay, so the weekly closes are what we would call a macro confirmation. Okay, weekly closes are what we would call a macro confirmation. Okay, so if I can get the monthly signal triggered, and it also closes the week with that signal triggered, then I have macro confirmation. Now I can take that trade right then and there, or I can look at a lower time frame chart like the hourly chart, for example. Look for like a bounce and a lower high on the hourly chart, and then take that trade at that point, right? Because I know I like the bearishness, but maybe I want a better entry. I can do that as well. All right. Now, the last thing I want to talk to you guys about is risk management. There's built-in risk management all around the spreadsheet. I repeat, there's built-in risk management all around the spreadsheet. We'll start from here and work our way backwards, right? We'll work our way to the right. For starters, each and every one of these weekly pivot points, right, has a stop loss attached to it. So let's say you said, you know what? I like what Deron talked about on Saturday. I like what he talked about breaking this first resistance right here. I'm going to take a trade if we break this first resistance. Let's say that's what you said. Well, this is your automatic stop loss from that first resistance. So if you get in and it immediately pulls back and breaks this level, you get out of the trade. That's it. You're done. Right? If you're getting in, if you go from the first resistance to the second resistance, then your stop loss moves up to this level. The stop loss is based on the average true range. It's based on the average true range, right? So I have the average true range automatically calculated in the spreadsheet. It's automatically calculated. Great question, Anthony. Right, so it's built in based on the ATR. And let me explain to you guys why every single bit of our risk management is based on the ATR. All of it's based on the ATR. Let me tell you why. Okay? Risk management that's based on the average true range it's factoring in volatility of the actual asset that you're trading. So if you happen to get into a trade, okay, all right, I'm happy for that, Yolanda. All right, so if you happen to get into a trade and it pulls back on you, it's less likely that you might get stopped out without there being a real cause for that. All right? It's less likely that's going to happen. Matter of fact, let me pump this open real quick for you guys, right? Watch this. So all right, watch this, right? Let's let AI take a crack at the explanation here. So the average true range is a powerful tool for risk management and trading, primarily because it provides an objective volatility adjusted way to set stop loss levels. Right? The key benefit of using ATR for setting stop loss orders are they're dynamic. Right? The dynamic adaptation to market volatility. So the most significant advantage is that the ATR-based stop losses are dynamic, meaning they automatically adjust to current market conditions, unlike a fixed dollar amount or a percentage. Right? High volatility, high ATR. In a volatile market, the ATR value increases. This leads to a wider stop loss placement, which gives the trade more room to breathe and prevents you from being prematurely wicked out by normal large price swings or market noise. So now low volatility, low ATR, you should get the point of that already. Now let me point something out, right? So right now I have your stop losses set really tight at the moment. But once you guys really start to build up those accounts and you start to really get up there, we're going to widen these stop losses a little bit. We're going to widen these a little bit. Right now, they're focused on 1 plus 0.25, right? So meaning this particular stop loss is focused on 1 standard deviation plus a quarter, pretty much, right? So no matter what, It has to exceed your 1 standard deviation or your 1 ATR by a quarter. Okay. Um, then you have your reduced premature exits, right? That's what it does. So it's noise reduction. Noise reduction. Okay. So by setting the stop loss based on the average true range of the asset's typical movements, its volatility, you effectively filter out random market noise. This helps you avoid getting stopped out of a fundamentally good trade simply because a temporary normal fluctuation, thus giving the trade a greater chance to develop in your favor. Now, the stop losses that we're using right now are built and based off of the ideology of high frequency trading, meaning you're going to get stopped out less. Let me point that out. You will get stopped out less, but it's still not wide enough to eliminate most of the noise. You're still going to get some noise in your trading, but that's mainly so the only noise that would normally kick you out of a trade is going to be noise that comes from macroeconomic factors. So an earnings report comes out or something like what happened on with those banks, something like that, or Donald Trump, with his tweets, and so little things like that come unexpectedly and bring unexpected levels of volatility into the market may still trigger these stop losses. But normal movement in the market should never trigger these stop losses. Okay? So let's keep that in mind. Now, you then have, their objective and consistent, right, placements. So ATR removes guesswork and emotion from setting stop losses instead of relying on subjective judgment. Example, I'll use a 5% stop. It provides quantifiable, consistent, and logical metrics, right? This standardized approach can be consistently applied across different assets and trading strategies, which is crucial for systematic risk management. Right. Then it says better position sizing. We're not really going to get deep into that one. Right. And you have pretty much the same formula here. So your entry price minus the ATR times a multiplier. That's pretty much what we use. Okay. So, if you look at the difference between these two right here, right? You see you have about $1.07, right, as your plus 25 cents, right? So watch this. I'm gonna do some math here with y'all real quick. All right. So 107 plus 25 cents. That's $1.32. Divide that by 243.41. All right. So that stop loss right there, this right here, is about just about 0.5%. It's about 0.5%. Okay. So look at this day right here, right? So you got about 0.67% to the downside. Okay. So let's go to the daily chart. Got about 0.67% to the downside, right? On this day right here. So let's look around, right? So see this? All right. All right, 0.67, all right, 1%, 1%, right? So, for the most part, right, you're up about 0.12% here, right? So for the most part, you can see, right, like a day like this right here, wouldn't have gotten you out, but this day did get you out, right? Again, so a day like this would not have gotten you out, but this day would have gotten you out, right? So little stuff like this, right? These little days, and it's actually 0.54%, right? So you see right here, this day right here would have gotten you out, and then you had a little more downside the day after, It rebounded, it bounced from there, but you get the point. All right, so you got some 0.42s here, some 0.45s, right? 0.59s, right? 0.5%, so on and so forth. So either way, the point being, you either way, the point being that look at the difference between your two, right? So you have about a $8 difference between these two right here, and so you're pretty much shooting for you know you're pretty much shooting for about what, like a close, just about close to a 4-to-1. With that being said, right? So that becomes a really good deal for you right there. Now, on the other hand, you have another risk management system that's right here, and this risk management system can be used for any trade. So even if I took the trade from here, wherever I took it from, these exit shorts and longs can be used for anything, right? And they factor in one full deviation, right? But it's one deviation from the high, right? It's one deviation from the high, so it's a pretty decent stop to utilize here, for most people. You want to keep it tight as you build these accounts. Again, all of our risk management for now is built more on high frequency trading. Okay, they're all built more on high frequency trading. So, in other words, we're looking for more opportunities right now than less. All right, we're looking for more opportunities. All right, and if you wanted to trade something that had a wider stop loss, you just go for something that has a higher deviation. So I can just trade SPY instead of IWM. Everybody get that? All right, and now I have a $5 deviation here, or 262 range that was going to be my, you can see here, right? Actually, just literally $2, right? It's a $2 range, right? So if I want to trade something, I can get I can trade something with a wider range if I want to. But I would recommend testing this stuff out with something like IWM first. So $2 to $3 range, test it out first, right? For the deviation, and then go from there. Your other risk management, your last risk management element is right here, and the swing points to look at. You talking about the risk management portion? Oh, taking swing trades. Yes, we did talk about that. I'm going to be recapping anyway. I'll be recapping in a second. So your 8-day trend is also a risk management parameter. So once this goes bold, your risk management then becomes when the bold, right, goes away, right? So as that lights up, that means you're in the trade. If this signal goes away, if that bold signal goes away, that means you're now a half a standard deviation below the most recent high. So let's keep that in mind. Okay? If that bold signal goes away, that means you're now a half a standard deviation below the most recent high. And that's something that you wanna really pay close attention to. Okay? So you're outside of the range to the, you're outside of that upside range, you're back in this range. And you want to be outside of that range to the upside or to the downside, right? And then your bullish or your bearish key level. right? Can be your exits as well. So if you want a wider stops, you can also use this as well. Okay. So for example, you're breaking your 244 here, right? You're breaking your 244 here, right? So my 242.80, right? My bearish key level can be a, see that? It can be a stop. See that? Look, 244.99. So if I wanted something wider than this, I can use my bearish key level here. Okay. So keep that in mind. So those are all your risk management parameters. Right. I have stops here. I have stops here, my exit long and short. And then everything about my 8-day trend can be a stop loss parameter. Okay. Everything about my 8-day trend can be a stop loss parameter. So keep that in mind. All right. Send a great tool to understand it better. Is there anywhere on the pulpit indicator that lets you know which standard deviation is using? Sometimes say it's um so as far as the you're talking about the like as far as like the stop loss system, it's typically always one standard deviation. It's typically always one standard deviation on the stop loss or 1.5. I mean, no, that half standard deviation, that's the natural built-in range. Right? That's just a natural built-in range that's there. Right? And all you're saying is if I fall back into that range, I want to get out of there. Right? I took a breakout and it fell back into the range. That's a false breakout. You gotta go. That's what that's saying to you. Does that make sense, Kenneth? So that's the only one there that's a half standard deviation. Everything else is 1 or 1.5. Okay. So keep that in mind. Everything else is 1 or 1.5. All right. Now, again, on the so just so we're clear, right? Somebody asked about swing trades, right? Anisha asked about swing trades. So all of your swing trades, and I'm happy you said that specifically. Anisha, I'm happy you used the term swing trades specifically, right? So I was talking about mainly like the breakouts and whatnot, but we could talk about it more from a swing trade perspective. All right. How can which part help you stay in trades? The 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 ranges you're talking about, the risk management portion, the fact that they're built on the average true range to begin with. That's what helps you stay in the trade. Right. So what helps you stay in the trade is that you trust it. Right. So for this right here, this is one standard deviation, right, or one ATR or 1.5 ATR below my most recent high. So if I hit a high today, let's say I'm hitting a high right now. If I hit a high right now, the only way I get out of that trade is if it pulls back to this level. And this level is based on the average range. You understand? Right? I repeat, this level is based on the average range. So if I pull back from the high by the average range, I most certainly might want to get out of that trade. Right? I most certainly might want to get out of that trade because, I've been told the average range is this much. Right? So we just need to think about that for a second. Like, why would I want the market to pull back by the actual the range is supposed to be going in my favor, right? I need that ATR in my favor, not against me. So we want to keep that in mind, right? So that's how it keeps you in the trades. Okay, so each one of these stops keeps you in the trade because they're based on the range that the market has set for these particular stocks. Okay, now again, I had them set a little bit tighter for high frequency trading, Kenneth. So they're meant to keep you in the trade, but they're designed to keep you out of volatile trades at the same time, right? We want smooth, trending, upward moving trades, right? You feel what I'm saying? So if the trade is a little too volatile, it'll take you out of that particular trade. But it's designed to keep you in most trades for as long as as humanly possible, right? But not allow the market to pull back too much against you. All right. And it's scaled to the hourly. So you can always get out of that trade, right? And then get right back in there once it starts to go back in that direction. It's again it's for high frequency because in the markets that we're currently in nowadays, you know, there's just a lot of volatility there that you don't want to deal with. All right. Now okay. Let's talk about this part here. So let's talk about the swing trades, right? And then we'll close out from there. All right, we'll close out from there once we talk about these swing trades. Okay. Now, on the swing trade side, as I was talking about, you have number one. Let's start from the left and work our way to the right. Number one, I break out above the first resistance, below the first support, right? These become swing opportunities, become swing trading opportunities where I can swing this towards the second resistance or second support. Okay. Again, my risk management is right here, right here. Okay. If I hit this key level, right, and I take the trade, I'm going for the second point of resistance, and I'm looking right here as my stop loss. When I hit that second resistance, boom, this now becomes my stop loss. Okay, just so we're clear on that. When you're taking these trades, if you're taking them with options, please, 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 more than 90 days on your contracts. Okay, that's the other way you can withstand the ebbs and flows, the ups and downs. 90 days or more on your contracts, please. If you're taking them with shares, then you're good to go. Don't even worry about it. Right? Just follow the stop losses. Just follow the stops. Okay, keep it simple. So if I got in right here and I'm trading shares, I set my stop loss right here, 243.67. Boom. Okay. When we hit the 252.20, I changed that stop to 250.87. Wait a minute, Anisha, hold on. So what you're saying to me is, you took a trade, you trusted the stop, the market pulled back, and it didn't hit your stop because the stop was outside of the range of the pullback. Is that what you're saying to me? So I'm clear on that. Oh, 90 days out. Gotcha. And the 90 days out. Okay, gotcha. Yes. You go 90 days out, when the market pulls back, what's going to end up happening is you're going to end up with, a pullback that doesn't really dramatically shift the value of your contract. Okay? That's very, very important. Very important, guys. All right. Now, so this is one swing opportunity here, right? And every time you hit one of these levels, boom, move your stop up here. All right, boom, hit this level, move my stop up here. Right now, when it comes down to the stop losses, it's the same as the confirmations that we talked about. You're looking for the market to close outside of these levels, right? Now, you can look for a daily close. You can look for a weekly close. You can look for a 1 hour close. It's up to you. It's up to you what you want to see there, right? Now, 1 hour, 2 hours, and 4 hour closes aren't bad for those that are swing trading. Don't hesitate to use those because sometimes if you have to wait for the entire day, you don't know what that's going to look like at the end of the day. So sometimes I use the 1 hour chart, the 2 hour chart, or the 4 hour chart for my closes, right? And I base that based on whichever chart I can see the trend on better, right? Because, like, look, let's go over here to the chart. So it's like, yeah, I can see a trend here. I can see it happening. I can see it. But these moves are only 1 and 2 candles. You see that? Like, I can't deal with that. So I need to go where I can see the trend better. So I go down to the 4 hour. Let's see if I can see the trend a little better on the 4 hour. Okay. I see a little bit better on the 4 hour. A little bit better on the 4 hour. That's better. All right. Let's go to the 2 hour. Now we're talking. Look at that. Look at that up and down there. You see that? See that? Now we're talking. Okay. Look at those ups and downs. I love the 2 hour chart. We can see that a lot better now. Right? Because see, if I look at the same thing on the daily, let's go back to the daily chart. Right? So the same thing there. Right? It's not enough going on there on the daily chart. So I might go to the 4 hour, 2 hour. Right? And that's going to represent my daily moves, right? I still use the daily chart. I still want to see closes above and below on the daily, right? And the weekly for my entries, right? And stuff like that, you know? But like a lot of times when I'm going for my stop losses and stuff like that, I might use the 2 hour or the 4 hour chart. And a lot of times I'm using the 2 hour or the 1 hour actually, right? Sometimes as well, right? So it all depends on how volatile I expect the week to be, right? Because we're talking about as long as it's hitting your level, right? And if it breaks your level considerably, right, then you already know it's time to go. All right. What do I call considerable? Breaks your level by 50 cents or more, right? If you're talking like these indexes and stuff like that, right? Quarter to 50 cents, whatever you're looking at there. Once it breaks it significantly, you got to go. All right. Now, okay. Let's talk about your other breakouts here, right? Your breakouts above your high and low range. Okay. So if you are consolidating here and then you break out in either direction, boom or boom, and you close that way on the daily, that's a swing. I'm going to swing that. I'm going to use my exit short and exit long to get out of there. If I'm on the high range and if I've been inside this range right here for days and I break out the upside, boom, I'm going to get in there and I'm going to look for, right? I'm going to look for the high end. I'm going to look for the exit long to get me out of the high end of the range, right? If I break to the downside, look at my exit short to get me out. All right, keeping it simple. Now, if you want to, just for the record, if you want to, you can look at the bearish key level as well. Right? These can also get you out of swings. Your bullish and bearish key levels can also get you out of swings if you want to use them. All right. Now, what would be great is if when I get these signals for the swings here, I'm getting the same signals here and here. Much stronger signals. If I'm getting the high range here, and I'm also getting the 8-day and the monthly trend, that's confirming those signals. Now, speaking of the 8-day and the monthly, whenever I get the 8-day trend, right, goes bold, or the monthly trend goes bold, that's a sign for me. Now, let me see if I can find somebody that's got let's go with Micron real quick. Okay, so Micron's got both key levels lit up. but they're not bold. So that means, right, we didn't close outside, right, of that those levels, but that's fine. All right. What matters the most is that you're above your bullish key levels on both ends. You just break. Look at this. What 1 standard deviation? One first, right? First range here. 1 standard deviation here. Right. Boom, boom. Right. And your bullish key levels are hit on both ends. Now, if we open up on Monday and then if you open up on Monday and then your 8-day trend turns bold, right? Then your 8-day trend becomes bold. Same thing. You want to see this lit up bold, and that's going to give you a new signal to take to the upside, right? It lets you know you're getting another push, right? So the reason this isn't bold right now is because it probably hit the high and then pulled back a little bit, right? But if you open up on Monday and this goes bold again, you're getting another push that you could possibly take. Now you have to know, well, how long has that trend been going? And you can just kind of look at this right here, your 20M, right? Look at this, right? If this is just getting bold when I'm hitting the 4 standard deviation, I'm not taking that trade. I'm not looking to swing that. I'm not going to swing that. What I want to see is it gets bold and then it goes backwards, right? And loses that bold structure and then goes back blank. That's what I want to see. It goes back blank and we fall out of the 4 standard deviation. Then I'm going to swing it back to the downside towards the 20 MA, towards the high end of the range. Okay? So those are the 3 swings that I would focus on, right? Your swing here, right? Outside of the resistance, right? First resistance or first support. Your swing here outside of the high end or the low end of the range, right? Confirmation from this. Or your swing when these become bold, boom and boom, and you're not too far up the scale yet, okay? Those are going to be really great swings. And the other swing would be if we get bold here, but we're already at the high end of the range, right? Here or here. If that happens, then I want to see us go bold and then fall back into, right, a blank state. In that particular case, that is a false breakout that I'm going to take back to the downside and back to the high range or back to the low range, right? Back to the 20 MA. So those are all your swings that you're going to take. The one that I'm going to challenge you guys with this week, is I want you to just kind of, practice with the first resistance, first support. I want you to practice with this one, right? Because this is going to help you with all the other ones. If you practice this one, it'll help you with all the other ones. This may not be my favorite one, but it helps. It helps, right? So what you want to do is you want to practice with that. So, okay, if you're above the weekly pivot and you're closing above the first resistance on the day, you take a long here, set your stop here. Okay. Also great if you're breaking out to the high end of the range and you're not this far, you're not too far along the range. Okay. Also, if I'm hitting the second and third resistance on the weekly, but I'm already far down the range, right? For the 4th standard deviation, 3rd standard deviation, I want to look for a pivot point rejection that breaks these levels and then falls back below them, right? And I'm going to look to take a swing back towards the 20 MA. So I want you to practice using this as your scale first, and then we'll come back around to the optimized signals, which are going to be very similar. But if you learn to use this, you learn to use this. All right? So let's start with this guy right here this week. This is my challenge for you guys. Learn to use this right here. right? So if this turns red, then I'm looking for support. Boom. If we can close below that on the day, and you're looking for like the last half hour of the day, right? Hey, listen, the last half hour of the day is volatile sometimes. So, you may look at the last 15 minutes of the day and see if you're going to get a close below this or above this. And is it supported by where you are on the 20 MA? You can look for support from the 8 MA as well. So if you're below the 8 SMA, that would help. So like right now, I'm above the 8-week and 8-day average. I'm above the 20-day average. So I'm looking for longs. Right? When you're above, right? When you're above the high range, you're above the 8, you're above the 8-week. I'm looking for long positions on Micron for now. All right. So whenever they pull back and do whatever they do, unless they're pulling back from 4 standard deviations or better, I'm not shorting this. I'm not shorting this. All right. What I would prefer to see is them to fall back to the high range, right? Get back into this range bound action right here, and then finally break out to the downside below 172-ish. Then I know I got something. Okay. So, anyways, so that's it for the day. Like I said, my challenge to y'all this week is to learn to use the weekly pivots. So when the week opens, right? Are you above or below the weekly pivot? Start with that. Am I above or below the low range or the high range? Start with that. If you can match these two up, you know what you're looking for. If these two match, I'm going in that direction. Okay. If I'm below the low range and below the weekly pivot, I'm going to look for shorts. From above the high range and above the weekly pivot, I'm going to look for longs. Okay? And then you can use these for confirmations. That's why I said, if you can learn to use this, you can learn to use these because you're going to get confirmation from here. All right, guys. So let's rock with it. Again, when I close the stream out, I'm going to go back over to Clubhouse for some Q&A first. All right. When I close the stream out, I'm going to go over to Clubhouse for some Q&A. And then we'll go from there. All right. For those that are, for those that are here on the stream and you are subscribers or you were gifted a sub by anybody, please note that you can come back and look at the replays on demand. All right. Also, shout out to Aldrin, shout out to GA for always looking out for the community and making sure that people have these opportunities to come watch ad-free and access the on-demand replays. You guys are amazing. You're awesome. Yes, definitely. Shout out to Anisha for reminding me that we could have, just come over here and done it on Twitch to begin with. I do appreciate that as well. So let's do this, guys. Everybody be blessed. Stay well. I'll see you back on Clubhouse. For those that'll be over there, let's do a little Q&A. I'm there to answer questions. Let's talk about it.